Hi, how are you? My name is Roy Reyes. Reyes means kings in Spanish. That's why I have the YouTube channels with the name Kings. I last time I posted a video was about 5 years ago. Many things have changed. I told you that time that inflation was gonna keep going higher and higher. At that time, the ounce of silver was $17. Now it's 55. The ounce of gold was under 2,000. Now it's only almost 5,000. This is going to continue. The government has too much debt, and it continues to get into more debt. In interest alone, they're paying about $1 trillion a year. All that money comes into circulation and generates more inflation. So today, I want to talk about a story, something that happened a few thousand years ago, regarding finances and the economy. And I want to show you that things haven't changed; they will not change. And when we understand that, we understand the fact that we have to do something different with our money to preserve our capital, to make it grow. Okay, so I have two channels. One talks about this one talks about finances in general, the Federal Reserve, interest rates, and other investments, all around money. And then I have another channel, with the link is below, that talks specifically about the stock market, how to buy, how to sell, and how to use a method that I like to use, and I've been developing and modifying it throughout the years. So let's get started. And if you like this, please subscribe. This video is for entertainment purposes only. I'm not telling you when to buy, hold, or sell any asset. Any transactions you make, you should consult with a financial expert. This is what happened in the last 5 years. You can see silver and gold went up. Now, don't let this fool you. Don't think that silver and gold goes up like this all the time. It's dormant for a long time. It's highly manipulated, the price, and then it went up. Now it's at those levels. It'll probably stay there for a long time. Who knows? But silver and gold, normally it should be a small percentage of your portfolio. But let's look at the stock market. Went up 75%. The whole average home price went up 50% almost, and your salary only 25. So what does this tell me? This tells me that every time I go to the supermarket, every time I pay my electric bill, it's going to be a higher percentage of my salary. Okay, and that's concerning because as time goes by, your salary just loses value, and you lose the ability to invest. You lose the ability to do other things with your money. So this was documented in the Bible, the year 1640 before Christ. I'm not going to get into religion. I do want to show you that the finances of things that happened back then affect us today in the same way. So there was a revelation of a dream that was given to the Pharaoh that Joseph interpreted. So basically, there was going to be 7 years of goodness and 7 years of famine. So Joseph had the green light to go ahead and build silos and start stacking up the grain. So then at that time, there were a lot of tribes around Egypt, and these tribes, they were hungry. They didn't have because the famine started. So they came and they exchanged their money to Joseph for grain, and he was happy to give it to them. But then time passed. Remember, this is a long time, 7 years. So then they came back with their livestock, their cattle, and they were able to exchange it for grain. And they went back, and again, this is a long time. So again, then they came back and they said, okay, we gave all our cattle, we gave our money, we don't have any more. So now we want to give you our land. So Joseph took their land, and they were given grain. But then again, they were hungry, and now they said, okay, we don't have anything else, so we want to be your slaves. So basically, they were willing to give up everything, even their livelihood, to be able to eat. But then, so what Joseph did was he let them work on their own land and pay a tax, pay a percentage of whatever they produced. And so they lost everything. And one key thing to note is that, first of all, this became a completely different situation for them. They were tribes, and now they were no longer any tribes. They were all part of Egypt. And this did not happen right away. It happened first. They gave them money, then the livestock, then the land, and finally their freedom. Okay, and basically, there's people, there's power that want this way of life, and they don't. They're vocal about it. You hear international organizations talking about this. So in times of crisis is when we wanted to give up more, like in 9/11, like in COVID, it's times like that we're willing to give up our freedom. But so the key thing here is that there was two groups of people. Okay, one group knew what was going to happen, so they prepared for it, and then the other group had no clue that was going to happen, and they were not prepared. And that's the key thing. So which group are we going to be a part of? Okay, we see inflation coming. We see what's happening to the economy, and And what's happening is I asked Chat GPT to give me an image of rich people and poor people, and the curious things that he put all white people up there. But anyway, the key thing is that it's there's a divide. Okay, it's probably several levels. Not this one's too drastic, but there's a divide between the people that have and the people that don't have, and that's what we're seeing right now. So these assets can be gold, they can be silver, obviously, they can be real estate, they can be in the stock market. Okay, so things that are assets, things that either produce money or things that hold their value with money. Okay, buying a car is not an asset because as soon as you buy it, it loses value. Okay, so what one way to get into to investing your money is with the stock market. Okay, you can start by buying an individual stock that represents a small percentage of a company. Okay, like here, and then so if you buy that stock, the company goes up. Hopefully, then the stock value goes up. Okay, an ETF is basically something that's managed by a team, and they go out and buy pieces stocks of 100 200 or or more stocks, and then you can go ahead and just buy one stock from this ETF without having to go and buy all these individual stocks. You just buy that ETF, and that now let's look at, okay, so what would have happened if I invested $50,000 10 years ago? Okay. And this is showing. So 10 years ago, if I put those 50,000 into NVIDIA, Apple, and then these ETFs. So you can see with NVIDIA, it was a massive $8 billion, uh, uh, which is crazy. And Apple is still a lot of money. It's $2 million. So, and what happens with an ETF? An ETF like QQQQ, which is the Nasdaq, it's still 300K, and the S&P 500 200K. So any one of these would have been, a good option. Now, this is not normal to for one. I mean, for what to find one stock that's going to go up that much. You have a lot of stocks. Okay, so which ones are you going to choose? And that's the dilemma. And that's what I teach in this course. Find stocks that are quality stocks and that are profitable. Okay. Now, a lot of these weren't, like Nvidia at the very start. It was, who would have thought that it was going to go up so much? So Nvidia got a little bit lucky because the GPUs started to be used for mining Bitcoin, and then the jackpot was when AI needed these GPUs to be able to train it. So yes, but for every one success, there are many 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 other stocks that went down or didn't go anywhere. So the key takeaway from here is that you need. This is what I do. I have a baseline. Okay, the baseline is kind of like I said in the other video. My baseline is kind of like, let's say, our safe zone. Okay, where the majority of my money is going to go into these ETFs because I know they're going to go up, most likely because they're diluted across many many companies. Okay, and some of these ETFs are actively managed. When a company's not performing, they take it out or they lower the percentage allocation to it. And then you have a small percentage that you're gonna. I don't like this lottery, whatever it says here, lottery, but you're gonna dedicate a small percentage. Well, that's what I do, to other individual stocks. And the way I do that is I look at the PE ratios. I look at how much are they making, what does the future look like. Okay, I do like the Warren Buffett thing, and that's what we're going to learn here. So some percentage, you hold the baseline, which is the majority, and then another percentage on other stocks. And then I also do other things which you'll learn as I go on how to multiply that with options. Okay. So when getting into individual stocks, I showed you the good ones, but if you would have put in, let's say, 50,000 in BlackBerry, which they had a great advantage, but then they didn't get past their little device, and then Apple came out with the Apple phone and all that. So if you would have put in 55,000, you would have pretty much had the same amount of money and probably lost, because if you look at what you can do with $50,000 10 years ago and what you can do now, there's a big difference. So the money has lost value. So yeah, it's maybe it's a little bit more, but in the reality is you lost value. Or if you got into some other stock like this one, this Walgreens Boot Alliance, you would have actually lost. You would have had your 50K, you would have had only like 7K right now. So yes, it's risky, or companies might even go out of business completely. So there's risk, and that's why you have to be careful. Okay, you have to be careful and know what you're going to get into. So if you buy this Vanguard ETF, which is the S&P 500, it's going to represent the S&P 500 stocks here. Now they allocate to some of these more percentage than others. Okay, so that's one of the management they do. And QQQQ is the Nasdaq 100. Now, if you go to Yahoo Finance and you type this in, you're going to see what percentage they're allocating to each one of these, and that's free to look at. Now, each one of these are going to have those good companies in there, those top quality companies, the companies that are generating a lot of money. So they'll allocate more percentage to those companies. And like I said, you can go to Yahoo Finance and look it up there. Now, these are managed, so you're going to pay a management fee. You're not going to pay the fee, but when you buy, let's say you buy one share of this, the fee is already included in there. Okay, so it's whatever the ETF costs. In the cost of buying one of those, this percentage is already included that they charge. Now, this is very low, percentage 0.2. Now, if you give your money to be managed actively by some company or a person, they typically are going to charge you 1%. So you can see 1% is very, very high compared to this. So I was giving my money at one point to somebody that was charging me 1% to manage, and he had everything in these ETFs and a couple of others. So I stopped using them because why am I going to pay an extra 1% for them to just permanently have my money in these ETFs? It doesn't make any sense. And this adds up to a lot of money. If you do this over 10 years, 20 years, so 1% adds up to 100, thousand, many thousands of dollars. And I'll go over that in a different YouTube video. So the step one, I would say, for if you're just starting, I would see like the ETFs more like a safe place. Okay, and then and start putting my money in there. And as time goes by and you understand more, then I would put money in, a little bit more money into some of the good stocks as well. So my method, what I do is I have a pool of money. Okay, and then this pool of money, what through methods that I'll go over in several classes, there are several YouTube videos going forward. The money that generates is then I put it into here. Okay, so I have an allocated working money, and where I do options, and if you don't know what that is, then you'll learn. I do the options, and then whatever that money generates, I put it in here, and then I let this grow. And then basically, this is the basic plan. You have the mindset. Basically, you put the money here, and you never sell it. You just keep it there. And I'll show you, I'll show you what I mean in other videos. But you keep the money inside these ETFs, and basically there's no need to sell it. There's no need to sell it. You just have some working capital, and you put it in there. Or if you have like a salary, right? Which most people do, then you get a percentage of the salary, and you put it, you set it aside into an ETF. So that's a way to do it. That's the way I recommend, and it's low risk. And it's very, very easy to do. At least getting part of your salary and put it in here. So for your homework, I'm not, these people don't sponsor me or anything. So open an account. There's several of these. You can do it on your cell phone. You can do it on your computer. Just open an account. You can do a paper trade. Some of these do allow paper trading, which is really nice. So you can start experimenting, selling, buying, and doing different things, and get your feet wet. So I recommend you do that. And then once you do that, you continue watching my videos. I'll show you what are the next things you can start doing. Okay, to finalize, I just want to say that I have two channels. One is called Investing with Kings. This is more general information about investing, the stock market, real estate, interest rates, and anything that affects your money. And then the King's Trading Desk is where I talk specifically about stocks. So I'm starting at a low level, and then I'm going to ramp up to the method that I use. Eventually, the method I use, you'll learn about options. You'll learn about a way to determine if you should buy a stock or not based on the intrinsic value, which is my whole main philosophy. And we'll get a little bit into technicals, but mostly on at the moment to buy the stock, not for day trading purposes. So if you like this, please subscribe.